the bots, and today is May 28th, 2013. In this broadcast, we are going to review the trading strategies for the day. Every day on the website, we will be adding a daily market recap. The focus of the daily market recap is to go over the market structure for that particular day. In addition to the daily market recap, we're going to add a review of the trading strategies. So what you're seeing here is the trade status monitor. This is where we enter the trading strategies. We enter the initial post as a strategy, and then typically we will add a trade management comment, perhaps a trade comment. There may be situations where the trade is taking some time to develop, and we may add additional comments if we feel it's appropriate. And then finally, we post the conclusion of the trade. The Follow the Bots website is for educational purposes, and the material that we present on the website is to illustrate the effectiveness of both the long-term and short-term algorithmic models that have been developed by Follow the Bots. The trading strategies are posted for educational purposes, and in order to introduce our members to the concepts behind the analysis of the market development and the role that the micro and macro price structure plays in the development of the auction process. If you are a new trader, we encourage you to follow the trading strategies in simulation mode. Open up your simulated dome and execute the strategies in accordance with the posts. This is an excellent way to gain experience, to make good use of your screen time, and after you have executed the strategies over a period of time, you will find which strategies appeal to you, and you'll ultimately develop your own niche and your own style. So that is the idea and the purpose behind the Trade Status Monitor posts. So to begin, I'll spend just a short period of time reviewing the context of today's session. So first of all, the S&P on the 22nd of May rallied up to a new multi-year high at 1685. So following the breakout above the prior two-day consolidation, the S&P rallied up to the new high. Each of the columns that you see on this chart represent a 30-minute sample. So the market spent the better part of 3 hours at the high, and then late in the day sold through the two-day trading range, and then sold all the way down to the 3-day low before auctioning up off the low and trading back to 1658. As the arrows clearly indicate, overnight the selling pressure increased, and the market traded down to what had been the prior major support level at 1632. The S&P spent 2 days at the low, so on Thursday, after trading to 1632, the market auctioned back up to 1654, sold back down again, retested the low on Friday, and rallied up off the low into Friday's close. The next two small segments are the overnight developments that occurred on Sunday, the Sunday Globex session, and then the shortened holiday session from Monday. So after closing at 1650 on Friday, the market auctioned up, again retesting Thursday's high before pulling back below Friday's close and trading down to 1644. On Monday, the market rallied up and broke out above the two-day consolidation range. And at the open of today's session, the S&P auctioned up to 1670, 1672, the lower edge of the upper supply cluster. The market sold off from its retest of resistance, traded back down below the two-day high, did not trade down to fill the gap at Friday's close down at 1650, held slightly above there, auctioned back up again to 1662 before ending the session at 1655. Now, in the video that I posted on the website yesterday, we went over the support and resistance levels. And so we talked about the high up at 1655, 1658, and the statement was, coming up off of Friday's low, the initial rally to the high would provide an opportunity to sell the retrace. Now, you'll not find this trade posted in the trade status monitor because, again, this trade occurred during the holiday and I did not myself take that trade. So you may wonder, well, why are you posting it if you didn't take it? And there is a reason why I'm going over the trade, because I inferred that would occur. Now, circumstances were such that I wasn't present when it occurred, but it is important to me, as it should be important to you, to keep a record of your inferences, whether you are physically present to take the trade or not. This keeps you in sync with the market and gives continuity to your thinking. It is not simply a matter of moral victory, it is preparation. You see, had I been trading, I would have taken those trades. So I'm not simply going over it for the sake of some moral gratification. That was my strategy, and it developed in accordance to my inference. So following the pullback from the first retracement of Thursday's high, we had this overnight low down at 1644, and the next time up the market broke out. So here's the breakout. This represents a transition out of the two-day consolidation, and the expectation was that if the market broke out, it was going to trade up at or near 1670, and that was going to create a short opportunity to sell the retracement up to the lower edge of the supply cluster. So this would have been a great breakout trade. This was the opportunity to get short. The market pulled back off of the high, paused before trading down to the transition point, traded slightly below the prior high, not really by much, and then auctioned up off the low. Now, here is the chart that was up on the broadcast monitor at this morning's open. So you can see clearly the overnight low down at 1644, the transition point, the breakout above Thursday's high, the projected upside target. The market hadn't gotten there yet when I took this image. It hadn't traded up there yet, but that was the upside target. Let's take a look at what happened during the transition. So first you see here the rally. So first of all, this happened overnight, right? This happened first, then it pulled back, then it came back. So this would have been now the fourth time the market traded there. You may have been thinking to go short there initially. There was a order flow event alert indicating buy programs waning. That might have provided you with a rationale to go short. Certainly there were 2-point profit there for having shorted it. But now look what happens here again on the retracement. Okay? Do you see now how the digital filter is pointing up? Now do you see the slope of the digital filter going exponential? This doesn't happen when the market stalls at the high. When the market stalls at the high, here, look over here what happened when it first came up. Okay, when the market stalls at the high and you get a buy programs waning, okay, now look at how the average goes flat. All right, you don't get challenged again. You see the distinction there? Here you have an exponential move. You don't want to, if you sold it again or if you were still holding it because you didn't want to just take 2 points, if you were holding for more, this is what you do not defend against. No benefit, little to be gained is what I usually put in the trade status monitor by holding on to the short. And certainly it's not advised to be a scale-in seller. In other words, you don't want to hold a short and keep selling it and keep selling it and keep selling it. Nothing to be gained by that. What you really want to do is to exit the short and buy the breakout with the expectation that the market's going to trade up to the upper cluster edge at 1670. Now you see price approaching the cluster. So here's the first probe up to 1670. Now you're starting to get buy programs waning again. Notice how the slope of the digital filter now is starting to go flat. Okay, you see the slope now starting to flatten out. And then finally the turn. So if you're looking at this chart, and we have this same chart up on the website. Now the chart on the website is slightly delayed, so it may not be sufficient for you to trade off that chart. But the idea there is you can go back and look and see on that chart where the events occurred. And so here you have a buy programs waning, you have orders replenished, and then do you start to see here now you begin to get the high frequency sell surges, and the average is almost flat. So from the short at 72, we had an initial target of 4 points for the market to pull back to 68. That was the minimum profit target, 4-point profit target. And we were expecting to see the S&P pull back down to where it had paused earlier here at the open, down in the 64, 62 price level. And so here was the pullback to the 64s, and that was along by the pullback. We noted in the trade status monitor that that was considered to be an aggressive trading strategy. Buying the pullback at 64 was not an ideal entry level. Again, the ideal entry level we were looking for was down at the 65s, almost 10 points below there. But we expected to see the S&P uptick back at or near 68. But there was going to be an issue retracing back up at the high because all of this selling that occurred, and if you looked at a volume at price chart, you would have seen that there was just tens of thousands of contracts that were executed there as the market downticked off the high. So that concludes our recap of today's trading strategies. Thank you very much for joining us, and trade well, my friends.